Hello. We're going to watch a video segment from 60 Minutes. It's talking about the roots of the economic problems that we're in now. And I don't remember when it was recorded. I guess it was last month, maybe in September 2008, I don't know.
This the silliest period in many ways. Now, again, that's with hindsight, because the argument at the time was, these are grown-ups, they're institutions with a great deal of money, government will only get in the way, fears it will be taken overseas, leave it alone. But it was a wrong-headed argument, and turned out to be, of course, extraordinarily unwise.
What role did Alan Greenspan play in all of this?
Well, he made clear in his public speeches and book that a libertarian drive was part of the way he looked at the world. He's a very talented man, but that didn't take us where we had to be.
He was, another former commissioner told us, hard to argue with at that point.
Alan was the most powerful man in Washington in a real sense. Certainly a rival to the president, and had enormous influence on Capitol Hill.
And he was at the height of his power.
He was at the height of his power.
Within 8 years, unregulated derivatives and swaps helped produce the largest financial services economy the United States has ever had. Estimates of the market for credit default swaps grew from $100 billion to more than $50 trillion. And you could bet on anything from the solvency of local communities to the fate of General Motors. They also helped produce a huge transfer of private wealth to Wall Street traders and investment bankers who collected billions of dollars in bonuses. A lot of the money was made financing what seemed to be a never-ending housing boom, selling mortgage securities they thought were safe and credit default swaps they believed would never have to be paid off.
The credit default swaps was the key to what went wrong and what's created these enormous losses.
Is it your impression that people at the big Wall Street investment houses knew what was going on and knew the kind of risk that they were exposed to?
No, my impression is the contrary. That even at senior levels, they only vaguely understood the risks, they only vaguely followed what was going on, and when it tumbled, there was some genuine surprise, not only at the board level, where there wasn't enough oversight, but at senior management level.
They didn't know what was going on in part because credit default swaps were totally unregulated. No one knew how many there were or who owned them, and there was no central exchange or clearinghouse to keep track of all the bets and to hold the money to make sure they got paid off. Eventually, savvy investors figured out that the cheapest, most effective way to bet against the entire housing market was to buy credit default swaps. In effect, taking out inexpensive insurance policies that would pay off big when other people's mortgage investments went south.
I know people personally who have taken away more than $1 billion from having been on the right side of these transactions.
Jim Grant is the publisher of Grant's Interest Rate Observer and one of the country's foremost experts on credit markets.
If you can and you could lay down cents on the dollar to place a bet on the solvency of Wall Street, for example, as some did, when Wall Street became evidently insolvent, that cents on the dollar bet went up 30, 40, and 50-fold. Not everyone who did that wants to get his name in the paper, but there are some spectacularly rich people who came out of this. And
who got richer?
Who became fantastically richer.
A lot of them were hedge fund managers. John Paulson's Credit Opportunities Fund returned almost 600% last year, with Paulson pocketing a reported $3.7 billion. Bill Ackman of Pershing Square Capital Management said he plans to make hundreds of millions. Both declined our request for an interview.
It is a betting game, folks. It's a betting game.
Congress now seems shocked and outraged by the consequences of its decision 8 years ago to effectively deregulate swaps and derivatives.
This is casino capitalism. That's what it is. It's casino capitalism.
And various members of the House and Senate have hauled in the usual suspects to accept or share the blame.
Well, you're wrong. Credit default swaps, I think, have serious problems associated with them.
It appears to be the first step in a long process of restoring at least some of the regulations and safeguards that might have prevented or at least mitigated this disaster after the damage has already been done.
Where do we go from here?
We need the most dramatic rethinking of the regulatory scheme for financial markets since the New Deal. If anything has demonstrated that imperative, it's the economy right now and the tragic circumstances we're in.
How much danger is still out there, do you think?
We don't know. Part of the problem of the lack of transparency in these markets has been we don't really know.